Hey guys, absolutely great to have you here with me. In this video, I will talk to you about the pros and cons of scalping, and I'll give you some technical tools that you as a scalper might use. We'll take a look at how to use Bollinger Bands, support and resistance levels, technical confluences to find trading opportunities in gold or any other market. I will also share with you some key facts about the relationship between the success rate and the reward to risk ratio. This is actually knowledge that you absolutely must have before you start planning your scalping strategy in gold or any other market. First of all, please do remember that we don't provide any investment advice, and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. So, before we get any deeper into this topic, we obviously have to define what we are talking about. So I'm going to use a chart here. This is a gold 5-minute chart, and I'm going to help you to understand what scalping is about. Originally, it meant traders taking the difference between the bid and offer. So that was basically, scalping was referred to catching the spread. But nowadays it has a wider meaning, and often if we look at gold like we're looking today, it could mean anything from 50 cents to a couple of dollars. So first of all, we identify levels of interest in the market, the same as usual. Here we have a level that used to act as a resistance, and after the level was penetrated, it provided a couple of occasions where the market bounced, and these are trading opportunities. In this occasion, the trend kept on going higher, but if you, at the time, let's imagine the hard right edge of the chart was here, if you didn't believe this was going to continue, then you might employ a scalping strategy and take maybe 50 cents to $1 out of this market and then forget about it and then go and look for another opportunity. So that's basically scalping. What scalping means, at least in my world. Somebody else might give you a different definition for scalping, but that's what we're going to talk about today. Let's quickly take a look at pros and cons of scalping strategies. First of all, the benefits. One of the definite benefits is that you are not in the risk of market reversing against you in similar way as long-term traders are. If you are a trend follower, you might see a market reversal that really takes big chunks out of your profits away after, even if the market has already run in the right direction for some time. Then a good scalper might have a success rate of 70 to 80%, but I have to warn you, it takes time to become a good scalper. You need to put in a lot of hours, a lot of learning, and a lot of discipline to get there. And the third benefit is that you don't have to pay attention to the fundamentals. You don't have to understand all the ins and outs of the market. You just concentrate on exploiting a well-studied and researched pattern that you know has an edge. You go and buy and you sell, or you sell and then buy back. But these trades are over quickly. It's just you just take advantage of momentum or mean reversal or whatever is your strategy. But then the downside, it requires a lot of screen time. And it requires a high precision in entries and exits. So this could be physically exhausting, and you have to think whether you are prepared to do this 8 hours a day or maybe even more, 5 days a week. If this is the life you want, then go for it, but know that it's very demanding. Then another downside is that you pay the spread maybe even thousands of times per year. Depending on your activity level, you could end up paying significant amounts in spread. So This is expensive and it creates a higher pressure to perform. Your strategy needs to perform really well to cover the cost and then turn in a profit. Then there's the opportunity cost. You could be making money elsewhere, working elsewhere, or you could be trading a different kind of strategy and working at the same time. So these considerations you have to take into account, and hopefully this video will help you in deciding what strategy is good for you, whether scalping gold is good strategy for you. Then the technical tools for scalpers. They really are very similar to any other trader. It's basically, if you're looking to trade gold CFDs and scalp the gold CFDs, you probably will be looking at these tools. Support resistance levels, Fibonacci retracements, moving averages, Bollinger Bands, and in general technical confluence levels. So I'm going to give you some examples here. Moving forward, going to support and resistance levels examples first. Here I have an hourly chart and a support level where the price bounces higher. So I'm basically including this hourly chart here to highlight the fact that the same technical principles work in all time frames. Whether it's an hourly chart or 1 minute chart in gold, you are still looking at the same principles. Here in this chart, I have 1 minute levels, 1 minute candles, and a couple of levels. In both occasions, we have price finding resistance there and here too, and then the same levels act as supports. So these supports are buy opportunities for scalpers. It could work for a quick 50 cents, $1 move, or it could be something that you might want to consider holding longer, depending on your approach. Really, you have to research that the charts, go back with historical data and decide what is good for you. Then Fibonacci retracement levels and moving averages. Here I have a couple of examples. First of all, the price retraces to 38.2 Fibonacci retracement, stalls there. It basically means that there is more demand than supply here, and that's an opportunity to go long. Then when the price retraces, there's an opportunity to buy at the moving average. The moving average is bullish, it's pointing higher, and the price action is mainly staying above the moving average. So we have a bullish setup here, which makes sense, and in which environment it makes sense to look for buy opportunities. Then Bollinger Bands. Here I have a couple of examples of how to use the Bollinger Bands. First of all, when the market rallies higher and then retraces back, that's a sign of weakness when the price comes inside the upper Bollinger Band. But when it creates a lower high, that's kind of a confirmation that we have probably a retracement or deeper retracement ahead. So that's a sell signal there. Then we have a technical confluence example where 1 minute gold retraces to this same 38.2 Fibonacci retracement level, and at the same time we have the lower Bollinger Band there. So we have technical confluence, a couple of technical factors coming together, giving this level more a higher validity or greater validity. So that's something you might want to consider using also. Okay, let's talk about success rate and reward to risk. These are highly important factors when we are creating a scalping strategy in gold. Success rate needs to be high if we are looking to take small profits. Gold spread varies between 50 to 30 cents, and so if you're only looking to take, say, 1.5 to 2 times the spread, which means that you're scalping, then your success rate needs to be high. Another consideration that you have to sort of pay attention to is that if you identify a reliable entry point, then you need to ask yourself how often the market has moved only 50 to 100 cents from this setup. To find the answer, you have to go through the historical price data and study the typical results from this setup, typical moves from this setup. And if you find that the market tends to move $2 to $5 from your signals or setups, then why should you scalp? Why should you only take the lousy 50 cents if you could have 10 times more? Let's pay attention to this. I have a table here which basically gives you the required success rate for scalping. If your reward to risk ratio is only 1 to 2, so meaning you are risking 2 times more than you are taking out of the market when you have a winning trade, then the success rate required to be break-even is 67%. So you have to be correct 67% out of say 67 times out of 100 trades. You need to be profitable in order to break even, to cover the costs. If your reward to risk is 1 to 3, meaning that your stop size is 3 times the average winner trade, then your success rate needs to be 75%. And then if you are risking 5 times what you are making on average, then your success rate needs to be 83%. Think about this. Is this really something you want to do? You have to think this through before you start scalping. You have to decide whether this is the right strategy for you before you start even planning the strategy. And then if you're confident that you can be correct, if your research of your price patterns show that you can be correct more than 67% of the time, then yeah, feel free to go and scalp. But otherwise, I would really look for some other options like swing trading, for instance. Here I have the same table for swing trades. Basically, reward to risk ratio, if you are making twice the risk on average, then you only have to have 33% success rate to break even. So at 34% success rate, you are already profitable trader with a reward to risk ratio of 2 to 1. If you have the reward to risk ratio of 3 to 1, then you only have to be profitable 26% of the time and you're making money. So that's something that you really have to pay attention to and think this through. I hope you found this video helpful. You now have a much better understanding on what it takes to be a scalper, and I believe that you are also much better positioned to either create or evaluate your scalping strategy. Feel free to drop us an email on support@TIOmarkets.com if you have any questions. We look forward to your questions and emails. See you soon on the next video. Trade safe.